The macro is bloody awful. It's the largest, most concentrated tightening of rates that I think we've seen almost in history. We have the largest tightening of financial conditions on a broad measure, as opposed to, a lot of people use the Goldman measure. That's not that broad because it uses equity markets, and it's a weird kind of feedback loop between equities and that. But what I did was use the rate of change of rates, the rate of change of the dollar, and the rate of change of commodity prices, and it gives you a understanding of how tight money is. The other way you can look at it is the number of central banks as a percentage of total central banks raising rates. Those kind of things give us a growth shock that is ahead, that we're starting to see, that is quite sharp and severe. So we're talking about something where, GDP growth falls 3% or so. So a really decent sized recession. But it looks like my forward-looking indicators suggest that the bottom of this growth shock comes actually pretty soon, like March 2023. And so if the bottom comes, then you get the recovery side. So, to David Rosenberg's point, it ends up being about 18 months or 2 years, because we probably started some sort of recession at the beginning of this year. So the macro is bad now and is going to get worse. The narrative you will see is, well, the macro is about to get terrible, all assets must fall. But once you start doing things like doing the year-on-year rate of change of the S&P or the NASDAQ, they're actually pricing in an ISM, the Institute of Supply Managers survey, of about 40. So that's pretty severe recession as it is. Could they price in a bit further? Could it be at one lower stab? Sure. But these are forward-looking assets. And what they look for is the turn. Why the turn? Because that's somewhere in the next 6 months, the central banks will most likely go, okay, unemployment's coming up, inflation's coming down. We have to look after, our mandates are unemployment and inflation. Inflation's going to be maybe stickier or higher. I don't believe it will be. I think it actually goes negative. But unemployment's going to be coming up. We need to at least stop. So if the rate of change stops, right, you've stopped the pressure on markets. Now, it doesn't mean they explode higher. It's not 2021 all over again. But if the pressure stops because the rate change, because QT stops and they stop raising rates because they want to see how bad this is. Okay, so the probabilities then come of rate cuts, or if not, at least it's going to be stability. They're unlikely to raise rates higher. Okay, so that's generally good for risk assets because they're forward-looking. So that's where it comes into crypto. So crypto is really interesting. Same with technology stocks, is they are in an exponential logarithmic uptrend because they are network adoption models. So in technology stocks, we've got the relentless, ongoing, ridiculous pace of rise of AI, robotics, EV, space, Internet of Things, 5G, 6G. Genetic sciences, all of these things are all coming together at the same time. It's the fastest pace of change humanity will ever go through. It's hard enough for us to deal with on societal level, but that's not stopping. Part of that is blockchain technology, digital assets. They're in the same exponential trend, but maybe even faster, because crypto with 300 million users is the fastest adoption of any technology the world has ever seen, twice the speed of the internet. So what you're thinking, so if you can visualize, is you've basically got this massive uptrend that is exponential in nature, but when you put it on a log trend, it's quite nice and smooth. But you've got these big swings. Those big swings are driven by the macro. So what we've done is we're at the bottom of the macro cycle. The beach ball is now being held underwater. But don't forget, every day there's new people building in the ecosystem, there's new adoption. People like Ticketmaster have issued 10 million NFTs without anybody realizing. The scale of what is happening is ridiculous. So the beach ball is held underwater. The moment quantitative tightening or rate rises stop, the beach ball rises above the water. You can't hold it down. And so that is why I am incredibly interested at this moment in time, right here, right now. because I think we're getting very close to the point where growth implodes. We've already seen 2 quarters of negative GDP in the US. We've already seen housing rollover. We've already seen supply chain issues ease. We've already seen most commodity prices fall 50%. We've already seen the dollar explode higher. The dollar's hugely deflationary because the largest exporting nations in the world, Japan, Germany, China, have all seen their currencies decline massively. So they're now selling finished goods at much lower prices. So the macro turn is very close. When we look at on-chain analytics, we start to see things that only ever happen in these massive bear market sell-offs. The 2014 sell-off, the 2017 sell-off, stuff like that. We also are at the bottom of the logarithmic trend channel, 2 standard deviations oversold. That's usually a good one. We're at the 5-year exponential moving average. That level has proven to be about the best risk reward you could ever find. Things like, if we use technical analysis, things like the RSI are as oversold as they have been at the bottom of every other cycle. So we've got this massively oversold crypto market at the time where the macro narrative is at peak. Everyone's like, inflation's going to be 20% forever, and Europeans are going to be dying in the streets because there's no food, and they're going to, they can't afford to heat their houses, right? That's the narrative right now. Okay, so how much worse can this be? And any rate of change means that the risk reward of digital assets from here, normally when you get to this confluence of events, the risk reward is somewhere between 20 to 50x. Yeah. Now, it depends where you are on the risk curve, which is going to ask the second part of your question, Mark. So Bitcoin is the least attractive asset because it has least attractive of the major assets because it has more stability, further network effects. Therefore, as you get further network effects, your growth comes down over time. So, where would Bitcoin go in the next cycle? Who knows? But let's say 200,000. But then we look at the network adoption effects in Ethereum. How many people are building on the Ethereum network? The ability to now get yield on the network. What's that going to mean for DeFi? Who's going to build DeFi on top of this new kind of benchmark yield rate that's coming out of this? All of the people who are building NFTs, all of the stuff going on, okay, that's mainly happening on Ethereum right now. Great. Ethereum's slow and Ethereum's expensive. So the market will seek the path of which they can get more stuff done at a faster pace, and they will make trade-offs. Trade-off is decentralization versus speed and cost. So when you move out the speed and cost curve, you basically arrive at Solana, Avalanche, Algorand, a whole bunch of these layer ones. So, then you start splitting out those assets and say, okay, how do I differentiate? And it's quite difficult, unless you're a technologist. But basically how I perceive it is Solana seems like it wants to go for the masses and create these kind of onboarding experiences, front end, they've got a mobile phone, they've got amazing NFT marketplace. They seem like they want to get involved in the public. Then you've got Avalanche, and that seems to want to be more technical. We've got these subnets, you can do your things, it's a bit more technical, and we can probably financialize real assets on it. That seems to be their narrative. Algorand, somewhere like the financial marketplace, stuff like this. So I just look at these and say, okay, what we're going to see is the market probably, Bitcoin underperforms, Ethereum next, whichever one of these, and I don't know which ones, will do pretty well. And then there'll be new tokens of which we don't really know yet coming in that solve more problems, where you'll see the 1000x upsides that we've seen in past cycles. And then there's a bunch of shit that goes to zero. Well, it doesn't go to zero. It just, goes up and down with the speculative hype flow. So that's kind of how I'm seeing that. So in the asset management side of what I'm doing, we're going further out the risk curve now, finding people who are taking those bets, because those bets are going to be more important drivers of returns than ETH or Bitcoin over time. When have you ever found an institution who buys at the low? What we need is FOMO, right? Most of them, I mean, I've spoken to a lot of them. And, giants like Apollo, they're all over this space. The giants, giant pension funds, giant endowments, the big sovereign wealth funds, the Middle East, everybody's all over it. The reason they haven't allocated a lot of them have done VC first, because it's easy to get through investment committee. It's just like a technology investment. But then they've struggled with product. So, they can't invest in individual hedge funds. It's just too hard for them because, they can't do due diligence on custody risk, DeFi risk, stuff like that. They just don't know how to do it yet. It's too new for them. So, fund of fund products like you guys have built and I've built, those are going to be the kind of products that they need, much like it was for family offices. So I think they are all super interested. I know that hedge funds is the next part of the space that they will come into because I've seen this rule book, this playbook many times before. They're all doing the work on it. And you need that thing that makes them not feel like idiots, which is they need the price to go up. And I know that's stupid, but it is what it is, right? That's why family offices and high net worth investors have been much better at capturing the alpha in this space than institutions because they don't get fired. They don't get fired for doing the wrong thing. And regulation at the margin helps. Family offices and high net worth tend to be more risk-taking because they're in control of their own capital. So the fiduciary duty they owe to themselves, so they will say, I understand it's not fully regulated yet, but I will take the risk. And they've been compensated for that risk by doing so. Institutions can't do that because their fiduciary duty to these millions of people and all of that kind of stuff. So regulatory clarity helps them. And so people look at this regulation space and really, we need it if you want adoption. This libertarian ideal of nobody's going to regulate our money, this is our new digital money, you can't do it, is a fantasy because we all live in a physical jurisdiction. And the physical jurisdiction wants its share of taxes because you get benefit from being a societal member. Now, if you move elsewhere, I live in the Cayman Islands, so I don't pay direct taxes. Sure, we have taxes on import duties and other stuff. They always find a way to get money from you. But that's the thing, is if you live in a country you can't avoid taxes, they want to make sure they get their fair share. Because don't forget, the world is pretty much bankrupt right now. And they need to make sure that they collect as much taxes as possible. So I think regulation is a good thing. I think it's coming. I think the space where the battle is going to get drawn up really is DeFi, because DeFi needs KYC, AML, and it can't by its very structure. So we're seeing people spinning up new institutional KYC, AML versions of DeFi protocols, which I think is useful. So that means we'll end up with a bifurcated world, like, some of your funds, and in fact, half the world's funds are in the Cayman Islands. Why is that? Nobody's avoiding taxes. You're doing it because it's a tax neutral jurisdiction that allows a fair and clear regulatory framework for any dispute, legal dispute, but it also allows international investors to pay their own taxes in their home country. It makes it easy. So will we have offshore DeFi and onshore DeFi? For sure, because you can't impose US DeFi restrictions on an investor in South Africa. So I think we will figure out different ways of doing it, and there'll be bifurcated markets, but institutions will get what they need, which is they need compliance so they can't get taken to court. What is magic about this space is we all get to own a part of the network. So whatever they do on the space is going to benefit us if we own parts of the network. That's by owning the tokens. So I don't really care. As long as I've got my stake of the network, however the network is built out and whoever builds on top of it. So what they're saying is, we like the network, we like the technology, we want to build on top of the technology, and we want to build the ability to custody and transfer assets. Right? That was my hypothesis from day one, that was going to happen. It's just taken time. And I've spoken to the London Stock Exchange, I've spoken to everybody. They're all going to do it eventually. I've spoken to Dubai Stock Exchange. They're all going to do it. We've seen the European Investment Bank, the EIB, issue bonds on Ethereum. They're all testing it. So my hypothesis has been most traditional assets are about $200 to $300 trillion in market cap, whether that's real estate, bonds, equities. And my guess is this will be the same because it's going to capture a share of a bunch of that. So, 13 trillion, yeah, add that into the mix that gets us to $200 trillion of market cap. It's coming without question. The best thing is own the bloody token. You can say, well, we don't want the institutions coming in. Well, you might as well profit from it. Own the token. So I own the ecosystem, invest in the hedge funds, do whatever, capture the alpha and the beta of the space. So I've taken four big bets in this space because I think it's the best opportunity I've ever seen in my life, as I've explained before. One was investing myself with as much money as I possibly could. Two was pivoting Real Vision around this because I think it's faster growing, more engaging, and community is the future of all business models. I then also had the hypothesis that the entire financial system is going to invest in this. So that was why I built an asset management business. And then I knew that the masses were going to come. And the masses come really via, stuff like we talked about, like, securities and stuff, trading on blockchain rails, etc. Less interesting to me. What was really interesting was the tokenization of culture. And the hypothesis is the I think it was McKinsey said this, there's $63 trillion of global intangibles on balance sheets around the world. What is the value of brand and culture? Well, we don't know, but we kind of know it's a lot. But then I look at the share price of Disney and it's $250 billion. Disney's probably the largest, deepest cultural brand in the world by a long way. Everybody has a connection to Disney in certain ways. So if you tokenize the Disney ecosystem, whether it's Marvel comics or original cartoons or whatever, all of the stuff in the Disney archives, all of the legend of Disney, it's probably worth $1 trillion or $2. That's the power of tokenization. So at corporate level, you are highly incentivized to do this if you have cultural currency. Cultural currency are those brands, communities that have community and culture, deep culture. Where do those tend to lie? Sports. We all know that, right? Anybody who goes to a sports game, you know how deep culture lies, how valuable that is in and above common sense, right? It's something really deep. Music is another one. The other one we talked about before is fashion. Fashion is culture. Some people don't get it. That's okay. But why Bernard Arnault from Louis Vuitton LVMH is in the top 5 richest people in the world is he understands that scarcity and status go hand in hand, and humans just desire that amongst all things. People want to be more than just a number, and fashion does that. And we could probably throw arts into that. And then there is, the entertainment industry. So that's films, books, book franchises, TV franchises. I mean, they're huge. So those, I think, are the largest cultural communities. The other two on top would be religion and politics, which are not two I'd want to touch in this. But those, so all I know is every brand, the gigantic brand, everybody in the Web3 space is starting from the ground up, building like Yuga Labs from the ground up, these ecosystems. But every giant brand in the world is going to have to go this way. Yeah. So I want to be there, and I want to get the next 100, 500 million people into Web3. Now, how do we do that? Because people don't care about it's on Solana, it's on Ethereum, it's on Polygon. It's like the noise and the ridiculous complication of this space needs to go away. But people are doing this in the background fast. We realized this about 2 or 3 years ago and started to pivot the entire business around community and Web3.